Hello guys, welcome to the channel. I will be talking about fair value today specifically, and I will be talking about gap risk and how the two go together. So fair valuation is, I believe, the sixth video on the months one mentorship content. Uh, and it talks about fair value for the market maker and fair value for the traders. Now, I think this is the most important video of all the mentorship videos because it is really, as traders, we are trying to find good deals officially. Like, at first, we're trying to make good deals that have low risk opportunities. And a lot of people just trade fair value gaps or order blocks or things like that, but they don't really pay attention to their risk, their framing. A lot of you, this happens a lot of times to you guys, where you frame a trade, and the trade will play out later on in the direction you thought it was going to go in, but it knocks you out before you it drops or rallies. So this is a very big problem in the trading space. Most of the times those things happen, probably it just knocked you out where you entered, and you're like, it just turned like 2 to 5 pips away from where your entry is, so it's not much difference. And it's really shocking when it happens, and it happens again and again and again, and you probably had some profit before it knocked you out. You didn't take any partials because you were focusing on the risk to reward. So why do these things happen? So these things happen because basically you're not considering gap risk. So today specifically, like I said, I want to talk about fair value and gap risk and trading inside the range. A lot of times trading inside the range is a simplistic model you could use to carve out profits from the markets, and to trade inside the range in the context of the daily range, I think I'll be covering that today. And trading inside the range is, let's take today's price action for example. So as you can see, price weekly opened, then price went down a bit and rallied up to the previous weekly high, and then formed the high of the day, and then dropped to the middle of the range. So now you might not believe this is the high of the day right here, so you wouldn't have the confidence to go in and sell short at this moment right here at 8 p.m. 8 a.m. So you wait, and let's just say you sold at 11 a.m. targeting, since you believe this is the high of the day, you're targeting this fair value gap right here, and you sell at 11 and now when you do this, now is this fair value? Let's just say there's a lot of things that can happen at 11, because okay, now 11 was a down close, but then 12 p.m. opened, and 12 could do a lot of things. 12 could rally to this gap right here. We have a gap, very little gap right there, or we could go to the lower time frames and look for other we have this inversion right here. So when you enter right at 11 p.m. a.m. When you enter right here, some of you will frame your risk right above this swing high, and you'll have your take profit right here, and this is a 1 to 2.3 risk to reward, and the trade played out today, so it played out for you today. But why should this swing high be high resistance liquidity run, right? That's the way it acted today, and this is high resistance liquidity run. It didn't really run it, and it just dropped into your target. But a lot of things could happen right here, because you have to consider this inversion is right there, and we have another 1 hour fair value gap right there. And so the way we frame this risk, the proper way would be right here, because this is the appropriate way to frame the risk, because this is where price shouldn't go if it's set the high of the day today, because it could still right after 11 and 12 it could still come up and knock you out. If you entered anywhere right here below the gap, this region, it could still knock you out. So you're contending with this gap risk, and a lot of times this can make you it could give you analysis paralysis, and you don't want to enter right here now, because trading is so dynamic and these gaps could exist anywhere above or below. If we are buying or selling, you deal with a lot of stress. Anytime it starts to rally, you think, oh, maybe this gap exists right here, because IPDA is always filling imbalances, right? So inversion fair value gaps, they're always, IPDA wants to fill those. So this market is time-based delivery. So this candlestick has 24 hours to close. So in 24 hours, if it's set the high at 8, it has until 5 to close. I know ICT says the true day is until like 3 p.m. bond close, but sometimes you might see the price rallying up until the close of, which is the 5 p.m. So price could come up, say at 12 p.m., fill this range, just then drop after, or it could rally 12, 1, 2, and 3, 4, 5, drop into this fair value gap. So what you want to do mainly in your trading is that not take this type of trades. So if you didn't have the opportunity to enter here, if you didn't see the trade forming right here and had the confidence to sell it right there, you don't want to sell right here and just use this swing high to put your stop loss in, because What this creates is inconsistency, because if you're selling in, let's measure this range. This is the unrealized dealing range. So if you are selling right here, you're selling right at the equilibrium of the unrealized dealing range. So price still has more room to build a premium. So, and the remaining time on the day is pretty much a lot. So especially if you have to consider days that has news. If you have news on this day, selling at 11 would be not fair value for you, because it is 50%, but price, it didn't even reach OTE from the unrealized dealing range. So that means your framed risk on this trade is not high probability. Your stop loss getting hit is not low probability. It's actually high probability that your stop loss will get hit on this day. So if you keep taking trades that are like this, yeah, your win rate will not be so good. You might make money, but if you're just using the swing highs that exist on the lower time frame to frame your stop loss, that's not a good recipe for consistency. What you want to do is always measure the range and always enter above. Always just mark where you see the nearest trading inside the range, so the IPDA is gonna fill whatever gap that exists that day. And if it doesn't, it could go this sideways too. If this is the high of the day, it could be just up close like this. It could protract the rest of the day, or it might just do this like we have seen today. But what's the goal of this video is to teach you, anytime you have disinversions and little fair value gaps above you, price could always come up and close that and drop to your target. So fair valuation for a trader, as ICT put it, is we want to see, when we're selling, we want to see deep premiums being built based on the realized dealing range or the unrealized dealing range. If we're targeting something and there's enough time on the day, we want to be selling at the premium. That's the recipe for consistency. You want to do premium and discount. You want to measure your unrealized dealing range based on the highs of the days, the lows of the days, and the target and efficiency that you are targeting, and you will pass on the trade if it doesn't offer any protraction to build a premium. If you do this and you pass on trades that don't give you a premium pricing or a discount pricing, you will always have consistency, because you're always entering places after they're made efficient, and your risk to reward will be much better than entering lower time frames swing highs, framing your risk based on lower time frame swing highs and lows. And this is for intraday, obviously. This is if you want to have more velocity for your trades, if you want to find more trades, you can use this recipe. Just mark out the days. Like, I'll give you another gem, which is high of the days and low of the days are likely to form around monthly highs, monthly lows, weekly highs, weekly lows. daily highs and daily lows. Those are the places where usually the daily highs and lows form. So once you have the daily highs and lows form, you can frame trades that go back inside the range of the daily range. But the caveat is, because trading is dynamic, so it's always different, right? Sometimes your trades, even if they don't play out, if you always enter at the premium or the discount, the deep premium or discount, even if price wasn't to fill the inefficiency that you're targeting, if the high of the day and the low of the day is set, price can only protract the rest of the day, because we know that the market is controlled. The market is the high and the low of the day is set at midnight of the previous day. So the high and the low of the day, price cannot go above it. This market is an algorithm, so it's never gonna go above the high of the day. So if you can nail where the highs and the lows of the day are, and do an unrealized dealing range between where you see inefficiency and where price is at right now currently, and you wait for price to offer you a discount or premium, if you do this every day, every time, this is a recipe for consistency. You don't have to do anything else, and this framework will give you a lot of trades, at least 1 trade, 2 trade per week. And yeah, that's what I want to say. So we've looked at fair value. We have looked at like gap risk by the form of inversion fair value gaps, and civvies and BISIs, and we have considered time, and we have considered highs and lows, extremes of the day. So I hope this video has been insightful, and I'll come back with another video. Thank you for watching.